Okay, Home Depot. That huge retailer we all end up at for, well, everything home related. They just released their latest financials. And you have to wonder, what do these numbers really tell us? Is it just about drills and lumber? Or could there be uh, bigger clues in there about the economy, maybe even about how we're feeling about our own homes? Okay, let's unpack this.
Yeah, that's exactly what we're diving into today. We're looking at Home Depot's second quarter results for fiscal 2025. They came out August 19th, 2025. And they also reaffirmed their guidance for the whole year. So our goal here is to slice through all the, financial jargon. We want to get to the heart of what these numbers mean, what the implications are for you and for the wider economy.
Great, so let's jump straight in. The top line numbers for Q2 fiscal 2025, what did we see? Total sales hit $45.3 billion. That's up $2.1 billion, or 4.9% compared to the same time last year. Sounds pretty solid.
It is solid. And to give that some more context, let's look at comparable sales. That tells you how the existing stores are doing, right? Overall, comparable sales were up 1.0%. And if you look just at the U.S. stores, comparable sales actually climbed 1.4%. There was a slight drag from foreign exchange rates, maybe around 40 basis points on the total company comps. Just a small factor, less than 0.5%, but it shows, those global effects are always there in the background.
Got it. So currency took a tiny nibble, but fundamentally existing stores are growing. Okay, now let's shift to earnings, the profit side. The initial GAAP figures, that's the standard accounting stuff, showed net earnings for Q2 at $4.6 billion. That works out to 4.58 cents per diluted share. Now that is a tiny dip, actually, 0.2% compared to last year's $4.60 per share.
Right, a slight dip on the GAAP number. But here's where it gets, well, maybe a little more interesting. When you look at the adjusted diluted earnings per share, they actually saw a small increase. It went up slightly to $4.68 compared to $4.67 in the same quarter last year.
Okay, adjusted earnings. Why the adjustment? What are they taking out, and why does that adjusted number matter for us?
Yeah, it's important for getting the full picture. Home Depot adjusts for the impact of amortization expense, specifically from acquired intangible assets. So think non-cash costs linked to companies they've bought in the past. By pulling that out, they argue it gives you a, let's say, cleaner look at the actual operational performance of the core business day to day.
Right, okay. Stripping out those accounting items to see the underlying business. Makes sense. So sales are up. Adjusted profit is basically holding its own.
Right.
What's the story behind these numbers, though? What's driving this?
Well, Ted Decker, the CEO, president, and chair, gave some pretty direct comments. He said, I'm quoting here, "Our second quarter results were in line with our expectations." He also mentioned momentum from late last year carrying through. And here's the key bit. As customers engage more broadly in smaller home improvement projects. Oh, and he also pointed out they're continuing to grow market share.
Smaller home improvement projects. That's really interesting. Does that tell us something about consumer confidence, maybe? Like people are pulling back from huge renovations?
It certainly seems to point that way. And, the customer transaction data really backs this up. Comparable customer transactions, basically, the number of shopping trips actually went down slightly by 0.4%. But the comparable average ticket, how much people spent each time, went up by 1.4% to just over $90. So it fits that narrative perfectly, right? People maybe aren't doing fewer projects, but they're focusing on smaller ones. More frequent, maybe. Less expensive each time.
Yeah, like fixing a leaky faucet instead of remodeling the whole bathroom. So what does this all mean for you listening to this? It really sounds like a shift in how people are approaching home improvement.
I think so. It suggests maybe a bit more caution, prioritizing maintenance, quick updates, maybe smaller DIY stuff over those really big, expensive projects. Could be inflation pressure, could be economic uncertainty, maybe a mix of both. It's a real signal about household budgets.
Definitely something to watch. Okay, so that covers the recent past. What about looking ahead? They reaffirmed their guidance for the full fiscal 2025, didn't they?
They did, and it's important to remember, like you said earlier, fiscal 25 is a 52-week year, whereas fiscal 24 had that extra 53rd week. So the comparisons account for that. Key parts of the guidance. They expect total sales to grow about 2.8%, and comparable sales for that comparable 52-week period to grow around 1.0%. They're also planning on opening about 13 new stores, so still expanding physically.
Okay, what about the margins? What are they forecasting there?
They're guiding for a gross margin of roughly 33.4%, operating margin around 13.0%, and then an adjusted operating margin of about 13.4%.
Right, that adjusted figure again. And the bottom line, earnings per share.
So The standard diluted EPS is expected to decline by about 3% from the 14.91 they hit in fiscal 2024. But the adjusted diluted EPS is expected to decline only about 2% from last year's $15.24. And again, that adjusted number pulls out an expected impact about 40 cents after tax from that intangible asset amortization we talked about. Gives you that cleaner operational outlook.
Got it. Beyond the P&L, let's look at the balance sheet. A company's real strength often shows up there. What did we see?
Well, one thing that really jumps out is cash. Cash and cash equivalents shot up significantly. They ended Q2 fiscal 2025 with over $2.8 billion in cash, up from about $1.6 billion the year before. Merchandise inventories were up a bit too, which, makes sense for a retailer.
That's a big jump in cash.
Yeah.
Anything else stand out on the balance sheet?
Oh, yeah. What's fascinating here is Home Depot's total assets actually crossed the $100 billion mark. They're at $100,049 million now. And maybe even more impressive, they paid off all their short-term debt. It went from over $2.5 billion down to zero. Plus, they cut down their long-term debt, too. All of this massively boosts their total stockholders' equity, more than doubled, from around $4.4 billion to over $10.6 billion year over year. That's some serious financial strengthening.
Wow, paying off short-term debt completely
Yeah.
and reducing long-term debt while cash goes up. That paints a picture of pretty strong financial discipline. Now let's look at cash flow, how the money moved. You mentioned something interesting here earlier.
Yeah, the investing activity section, there was a huge change. In the first 6 months of last fiscal year, they used over $19 billion in investing activities. This year, for the same period, only $1.89 billion used.
$19 billion down to less than $2 billion. What caused such a massive drop?
It was almost entirely due to business acquisitions. Last year's figure included that big payment for acquiring SRS Distribution. This year, there wasn't a comparable huge acquisition, so that cash just wasn't spent on buying another company. Shows how much cash the core business throws off when it's not doing major M&A.
Okay, so way less cash going out for big purchases.
Yeah.
And what about financing activities? How they manage debt and equity?
That flipped too. Last year, financing activities provided cash overall. This year, financing activities used cash. And that was mainly driven by those debt repayments we just talked about, paying down what they owed. And of course, continuing to pay dividends to shareholders. They paid out over $4.5 billion in cash dividends during the first half.
So the strategy seems clear. Generate cash, use less for big acquisitions right now, pay down debt, and keep returning cash to shareholders. And it's good to remember just how big this company is when we think about these numbers. We're talking, what, over 2,300 stores?
Yeah, 2,353 retail stores, plus over 800 branches. They're basically everywhere, all 50 U.S. states, D.C., Puerto Rico, Virgin Islands, Guam, Canada, Mexico, and employing something like 470,000 people. It's immense.
And that scale is exactly why this matters to you, the listener. Home Depot isn't just a store, it's a barometer, right?
Absolutely. As the world's biggest home improvement retailer, its performance, and especially these insights about customers focusing on, smaller projects, that acts as a really important signal for broader consumer spending trends, for the housing market's health. It gives you this unique window into how regular households are managing their money and deciding what's important right now for their homes.
So let's wrap this up. Key takeaways seem to be: Home Depot had resilient sales in Q2, but the driver shifted towards those smaller, maybe more essential projects. They've also been really active strengthening their finances, building cash, slashing debt. And despite forecasting a slight dip in earnings for the year, they stuck with their guidance, suggesting, well, confidence.
Exactly. And, this raises a really interesting question looking forward. Given this clear trend towards smaller projects, and now that Home Depot has this stronger, more flexible balance sheet, how might they adapt? How might they change their offerings or marketing to really lean into these shifting customer habits? And maybe even broader than that, what does this sustained focus on smaller stuff tell us about where home improvement spending is heading in general?
It's definitely something to keep an eye on.